I will going to present the assignment number 3. This is our group member. For the profitability analysis, profitability analysis is a method to measure how profitable a business or product is comparing revenue generated with the cost incurred. The profitability analysis include return on equity, return on assets, gross profit margin ratio, and net profit margin ratio. The return on equity is a financial ratio that measures the profitability, efficiency, and capital structure of a company. A high return of equity generally indicate a company is generating a strong return on investment for its shareholders. For the return on assets is a financial ratio that measures a company's profitability in relation to the total assets it owns. A high return on equity, a high return on assets indicate a company effectively managing its production costs and generating a larger profit margin from its core operation. Net profit margin ratio is a financial ratio that measures the profitability of a company by assessing the percentage of net profit it generates relative to its total revenue. Set to Shine demonstrate consistently profitability with a high return on equity, return on assets, gross profit margins, and net profit margin ratio in 2021. The ratios even increased in the following year. However, Foodies has a overall lower ratio than Set to Shine company. Foodies profitability metrics show a decline in 2022 compared to 2021. The drop in return on equity and return on assets indicate decreased profitability and lower return on shareholders' equity and assets. Considering these factors, Set to Shine appeared to be more favorable investment option due to its consistency and strong profitability. The company has demonstrated efficient use of its assets to generate returns and shown improvement in its profitability ratio over time.
The asset efficiency analysis measures the effectiveness of its entities in generating sales revenue. The asset turnover ratio is a financial ratio that measures a company's ability to generate revenue compared to its total sales. Times inventory turnover measures the number of times per year that inventory is sold. Days inventory shows the average days it takes to sell inventory. Times debtors turnover measures the number of times per year that cash is collected from trade debtors. Days debtors shows the average days it takes to collect cash from its trade debtors. As a result, it can be seen that an investor should invest in Foodie Proprietary Limited because it has a higher asset turnover, higher times inventory turnover, higher times debtors turnover, and a higher creditors turnover, which shows that the company is generating revenue.
Liquidity. Set to Shine. Next slide, please. Set to Shine Pty Limited, expecting a suitable and balanced financial position with a good level of liquidity, as indicated by the current and the quick ratio. For the BTY shows a decline in liquidity and financial balancing, reflected the shrink current ratio and low quick ratio. BTY should closely monitor its liquidity and take a step to improve its financial balance to ensure its ability to meet short-term obligation.
So just to go over it real quick, the debt to equity ratio measures the level of debt financing compared to the owner's funds. The debt assets ratio indicates how many dollars of liabilities exist per dollar of assets. The equity ratio indicates how many dollars of equity per dollar of assets. The interest coverage ratio measures the number of times earnings before interest and tax can cover interest expense. And the CFO to debt coverage ratio shows how much cash flows from operating activities can cover debt for the business. So when comparing the financial positions of our Set to Shine and Foodie, it's clear that Set to Shine has a more conservative capital structure with a higher proportion of equity financing. The company's debt to asset ratio decreased from 2021 to 2022, while its equity ratio increased and its debt to equity ratio decreased. These ratios suggest that Set to Shine has a stronger financial position and may be less risky than Foodie, which relies more on debt financing and saw a drastic increase in its debt to asset ratio from 2021 to 2022. However, it's worth noting that both companies have relatively high interest coverage ratios, indicating that they have sufficient earnings to cover their interest expenses. Set to Shine's ratio did increase from 2021 to 2022, but it remains high. In contrast, Foodie's interest coverage ratio decreased drastically, which may signify underlying issues with the company. Another metric to consider is the CFO to debt ratio, which shows how much cash a company generates from its operations to pay off its debt. Set to Shine has a higher ratio than Foodie, indicating that it is better positioned to pay off its debts using internally generated cash. Despite these differences in financial position, both companies offer investment opportunities with their own strengths, weaknesses, and growth potential. Foodie has established a presence in the market and diversified product offerings, which may make it a more stable investment option. As of June 30th, 2022, its share price was $35.78, and its dividend yield was 2.60%. Set to Shine, on the other hand, has a higher dividend yield of 5.75% as of the same date, but its share price was only $1.03. While Set to Shine's higher dividend yield may make it a more attractive investment option, it is important to consider other factors such as market trends and company growth potential when making an investment decision. Ultimately, Valentina should consider her personal investment goals and risk tolerance when deciding between these two options. All right, that's it.